Again, I want to tell you briefly about an interesting conversation that I had with a fellow entrepreneur, and it will help you understand a bit about why I do what I do and what we're going to do today. I talked with him, and this guy is very heavily invested in gaining knowledge about things. He has read books, he's had courses, he's joined masterminds about cash flow management, you name it. And he could probably explain every financial framework out there. But when I asked what was actually changing with his cash flow, he said, not much. And that moment reminded me that knowledge alone doesn't build financial freedom. Execution does. Let's be honest. Most people know what they should be doing with their money. The question is, why aren't they doing it? Knowledge isn't power, it's potential. And information alone doesn't move money and it doesn't build wealth for you. Nothing changes until we take action. Real power begins when you apply what you've learned consistently and intentionally. That's when ideas become catalysts for turning momentum on and building wealth for you. Information can fill your head, but application fuels the results. So we're going to break that down today and see how to take the same knowledge that you already have about your money and turn it into a cash flow management and planning system that creates predictable, repeatable cash flow growth. So let's get started. First things first, cash flow management control requires a different operating basis than accounting. And I spent 35 years as an accountant and a tax preparer. And there is a different operating basis between that and cash flow management. And it takes a bit of a different viewpoint to understand cash flow management and planning and how it relates to accounting. So we're going to talk about that. First of all, what is accounting and why do we do it? Accounting is a historical record of what happened in the past with your money. It tells you how much income you made and where you spent it. And why do you do it? Primarily because you need the two financial reports at the end of the year that it produces, called the profit and loss statement and the balance sheet. Those are the two items that you hand to your tax preparer so your tax return can be prepared. That's the main reason we all do accounting. What's cash flow management and why should we be doing it? Cash flow management is actively planning for today and the future. How much revenue you need coming in, how you're going to make that revenue, and optimizing how the revenue is going to be spent to your best advantage. Why should you do it? Because it puts you, the business owner, in control of increasing your income and profits and when, where, and how your money will be spent. And that determines your financial condition of your company. It puts you firmly in control of achieving your financial goals. Now, as we go through the slides, we're going to talk about the system in steps. And you can take notes if you want to, but I did want to tell you that you're going to get a copy of my slides at the end. So you'll be able to go back through and you don't have to write everything down or take screenshots. All right. So here's a snapshot of the difference between accounting and cash flow management, but how they relate. Accounting is a recording tool that records the past. Cash flow management is a planning tool, and it plans the future. And the planning occurs before the money comes in and before any of it is spent. The first step in cash flow management and planning is coming up with a realistic budget. And a lot of people cringe when they hear the word budget. They think all it means is that they can't buy anything fun. They have to buy things they only need, nothing that they want but don't really need. And that's not at all the purpose of a business budget or a household budget. There are 4 purposes. 1, it helps the business owner identify where cash is being wasted. And I think we would all want to know that. 2, it alerts the business owner of cost creep. And cost creep is the things that you buy because of the type of business that you're in, like inventory. and your suppliers raised prices and you missed it and you didn't pass it on to the customer. So it can identify when it's time to raise your prices or shop competitive suppliers to protect your bottom line. It identifies exactly how much cash flow is needed to do better than break even and make good profits. We call that the income planning target. And it helps businesses fund expansion without going into debt. Now, some debt is good, not all debt is good. So we like to fund things that we need to fund with cash by saving it. So what is your income planning target and how do you figure it out? This is how to calculate your income planning target if you're using spreadsheets or paper and pencil. Based on 1 year of business divided by 52 weeks, you get the average of your weekly cost of goods sold. And we're going to talk about the details of why it's important to separate those things out in your accounting system so you know what those are. And you add to that your weekly overhead, your operating expenses to run the company. You go to the balance sheet and you add your debt payments. If you have debt and you want to get it paid off, or if you use credit cards and you need to keep up with paying them off when the statement arrives. And one of the secret sauces of cash flow management and planning is the 4 buckets of cash. That's what I call them. It's weekly savings and 4 buckets of cash for 4 different reasons. The first one is emergencies. The second is for business expansion. The third is for legal fees and taxes. And the fourth is for your retirement. If you add all that up, for a year, divided by 52, that equals your real weekly income planning target. And I can tell you that with the business owners that I've worked with in the past 35 years doing coaching, I always ask them what it's costing them to run their company. And it turns out they don't know. And when they noodle some figures around, they end up with a figure that's like 13 to 25% too low. So if they're planning their revenue generation plan on a number that's too low, they're technically planning to go broke. All right. Let's talk about cost of goods sold really quick. Some people know all about this. Some people don't do it, but we need to know about it. And the cost of goods sold are simply things that you buy because of the type of business that you're in. And the example I show you here is a veterinarian. Their cost of goods sold are things like biomedical waste removal, medical supplies, leashes, harnesses, dog food, cat food, something that a bakery wouldn't buy. I wouldn't buy it as an accountant. That's their cost of goods sold. Expenses over on the right are those things that any company, no matter what type of business they're in, would have to pay for. Now, a lot of time, coaches and consultants think that they don't have any cost of goods sold because they don't carry inventory, but they do. A coach or consultant has cost of goods sold, like an online scheduling calendar that would collect a fee, a Zoom subscription, a webinar and seminar costs if you do those things outside your office, a client management platform, virtual practice technology, branded virtual meeting rooms. Those type of things are cost of goods sold for a coach or a consultant. And the things on the right are things that you and I and anybody, including the veterinarian, would have to pay for. Let's talk about my favorite subject, the 4 buckets of cash. So the first one is savings, and that's for emergencies. And I define a financial emergency as a predictable expense that you knew was coming someday, but you didn't plan to pay for it. A good example for a coach or consultant or an accountant like me would be my computer crashes. It's dead. I need a new one. And hopefully I have a remote backup so I can restore my files onto another computer. For a person who owns a fleet of vehicles, if one of their vehicles blows an engine and they have to replace it, that would be a predictable expense. Vehicles don't last forever. So you can see what I mean by they're a predictable expense. The second one is for business expansion. And this is where you look down the road and decide how you want to grow your business and what does that entail. And it can be different things for different people. For a new business or a solo practitioner like myself, I've always worked alone out of my home. It can be hiring your first virtual assistant. That's business expansion. And you would want to save up for a couple of months of salary for that person because they are not going to generate revenue from the get-go. It's going to take them a while to be trained. For someone like a chiropractor or a dentist who wants to open a second clinic in another town, it could be finding the real estate, renting it, buying the equipment, and moving in and doing 2 days in this town and 3 days in the other town. That's business expansion. Legal fees and taxes. We all have some type of legal fees. If we do copyrights, trademarks, if we're presented with contracts, we want an attorney to review them to make sure that they're in everybody's best interest and nobody's given away the farm. And taxes, we have to pay sales tax if we take it in, and businesses do pay tax. Most of it is funneled through into your personal tax return, as you're probably aware, unless you're a C Corp, but still there are taxes to pay. And then the fourth bucket, which is my favorite, that is your retirement fund. We call it reserves in the cash flow system, but it is for your retirement. And you try like the devil not to spend any of it. And when it gets big enough, you start investing. And this is how you pay yourself a second paycheck every week. You want to pay your a salary in the budget, and you want that salary before taxes to be enough that whatever you bring home will fund your household. But in addition to that, if you don't save for your retirement, nobody's going to do it for you. So this bucket of cash is for that purpose. So this is a snapshot of how to find your income planning target. It is the buckets of cash, the cost of goods sold, the debt payoff, and regular expenses added up annually, divided by 52 to get a weekly number. I'm going to get a sip of water. The reason that we do cash flow management and planning on a weekly basis is it keeps the numbers small, and small numbers are easier to confront than a whole month's worth of numbers for a lot of people. But we do recognize that people like attorneys and insurance agents, they get paid their commissions once a month, and so they typically operate off a monthly basis, and that's fine. So here's a snapshot of the cycle of cash flow management and planning on a weekly basis. This is what happens. You start your week doing sales and income planning, and we're going to go through each of these steps in detail about what takes place, how you do it. So sales and income planning is how you're going to generate the revenue to meet your income planning target. And then once that's planned out, you spend the rest of the week executing the plan. You go to networking meetings, you meet people, you close deals, you follow up with people, you run your marketing programs and make sure that, the promotion is going out and, your referral partners are active. And then you get to the end of the week and you find out how much cash actually cleared the bank. And then you allocate the cash to your best financial interest. That's the planning part. You plan it out. And you come up with that plan. And then step 4, you execute the approved plan. So this is where you transfer the money into the buckets of cash. You pay the bills that you decided to pay. You pay off a bit on all of your credit cards that you're trying to pay down. And that all gets recorded in step 5 in the accounting system, sometimes simultaneously with step 4. And by that time, you're right back at the beginning of the next week to do your income planning generation plan again. So it's a very simple but powerful weekly cycle. So let's talk about these steps. Step 1, sales and income planning. What's your income generation plan to meet your weekly income planning target? First, you have to decide which products and services you'll promote and how you're going to promote them. And in my world, promotion and marketing is mandatory. It is not a discretionary expense. You have to keep talking to your potential customers and your current customers as well. So you decide which products and services and you fund that. And then you figure out who's going to sell what. And if you have a sales team, you assign tasks and quotas and targets. and have them write out a plan of what they're going to do. Then you figure out who's going to do collections. If you bill people and you wait for the income to come in, wait for them to pay your invoice, then you probably have someone who does the collections, and they would know who owes you what and how much money they expect to come in, and they can tell you who they could call to maybe get a 50%, of the invoice paid, if you wanted them to do that. And then it's very important to be able to calculate the return on your investment from the previous week and make adjustments as you go. And what I always recommended to my accounting clients was, if they had a sales team, that they had the sales team report it in at the end of the day, what they did, what they accomplished, what kind of deals they closed, if they, what kind of sales they made. And it can be in a text or an email, something simple, but that keeps you, the business owner, informed about what's going on. And you don't have to wait till the end of the week to, get the bad surprise that the week is a disaster because so-and-so got sick and they're not out there working. And, somebody who thought a deal was closed, it really wasn't. So you can take action in the midweek when you find those things out, and put some controls in or change the plan up a bit to try to make that income planning target. And then once that plan is made, you spend the rest of the week selling and delivering and giving great customer service. In other words, you bring in revenue and you don't spend any money. Now, that doesn't mean you can't have a per diem for gas and things like that, but you don't pay bills or anything like that. And the things that you do to supplement the income generation is you check your promotions going out. Did the emails or postcards go out? What message are you sending out? Is it working? Are people biting on the message? Did your sales team attend the networking event? What leads, need to be followed up on? And that's why I like for them to report at the end of every day, even with a text. Yes, I met with so-and-so and closed this deal, or I went to that networking meeting and I've got 4 leads to follow up tomorrow. Something simple. Step 3, at the end of the week, the business week, you go online, look at your bank account, and you find out how much money cleared the bank. You add to that any unspent income from the week before, and then you deduct the money that isn't yours. We all tend to think that, if $500 cleared the bank or $5,000 cleared the bank, that's money we have to spend. And that's not necessarily true, because we've promised money out to people in the past, and they're going to take it automatically. Bounce checks, approved refunds, commissions owed. We have to pay those commissions to the salespeople to keep them working. Merchant service fees are always drafted right out of your bank account at the first of the month. And you need to set aside money to replenish inventory if you carry hard goods, or you're in a business like carpet cleaning that uses a lot of supplies. Those need to be replenished. And then there's automatic bill pay. And a lot of businesses put their utilities on automatic bill pay because they don't want ever to have the lights turned off or the phone stop ringing because they forgot to pay the bill. So there are things that come out, and you need to scan your bank account to see what came out this week to find out how much you've really got left to spend. And then you allocate how much you've got left to spend in a very specific way, very specific steps. And you always pay payroll and payroll taxes first. Now, if you're a solopreneur like me, working alone, you may not officially have payroll. You may take owner's draws or something like that, which is fine as long as you don't take more than the profit of the company. But you need to still send in some estimated taxes. So that's very important to get that paid. The second most important thing is your promotion and marketing. Like I said, it's not discretionary, it's mandatory expense. You've got to talk to your current and your potential customers constantly because they're fickle. And if they decide that they need something or want something, they're going to most likely buy from, the last person that talked to them or sent them something in the mail. And then you follow the old adage, pay yourself first, and you pay into those buckets of cash in little percentages, little bits every week, and start those buckets filling up. And then you pay down loans, little bits every week against the credit cards. And the reason that you pay them weekly is the same reason that you would make an extra principal payment on your mortgage. If you pay your credit cards on a weekly basis, you're reducing the amount of money that they can charge you interest on, and it can save you thousands of dollars every year. Next to the last, you pay past due bills if you have any, and you pay them in what we call dateline paying order. The oldest bills get paid first, and you allocate about 15% of the money that's left to paying the past due bills. And finally, the last thing you pay is current bills. And you can pay those on a dateline, or you can pay critical bills first if you're running short. And you don't have the utilities auto deducted. You would want to pay maybe the utilities and a supplier that is supplying you something that you need in order to generate income. And you haven't paid them in a while, and you would want to send them some money. The only rule is you can't spend more than you make. And otherwise, I call this the dance. You decide, okay, I'm going to put 15% against the debt. But then when you get to the bottom and you still owe on a bill that you feel is critical and you need $150, you can start looking at the buckets of cash or the credit card payments and massage those a little so you get that extra 150 to drop to the bottom line so you can pay that bill. Just don't go to zero or below zero on the money that you have left. All right. So here's a proven truth. And I live by, operate, coach by this proven truth. It is not only how much money you make, it's what you do with it that determines your company's financial condition. I have worked with business owners who make just a moderate amount of income, but when they use this system and spend it in their own best interest and don't waste any of it, they do just fine. They're profitable and they can, fund their household with their salary that they pay themselves. On the other hand, I've also worked with very wealthy clients. I'll give you an example, a dentist in LA he's a cosmetic dentist and he only works on the, Hollywood stars, that type of personality. He makes a lot of money. He makes about $200,000 every month. And he got on my software system and he attended one of my seminars, and I was shocked to see him in the audience. So I knew I had to chase him down and talk with him at the end. And I asked him, I said, Dr. G, I said, I'm surprised to see you in the audience. And I know you got on my system. Do you mind telling me why? And he said, well, you know me. And I said, yeah, I do. And he says, I make a lot of money. And I said, yes, I do know that about you. And he said, let me tell you something. I make a lot of money and I spend a lot of money. I have houses everywhere. I have yachts. My wife goes to Europe and thinks nothing of spending $40,000 on a handbag, and then she carries it to one event. She comes home and gives it away for a charitable purpose. He said, I have a lot of stuff, but I have zero money in my retirement account, and I'm 63, and I'm scared. And that's why I got on your system, because he wanted a retirement fund. And it holds you accountable to put money in that bucket of cash every week. And of course, he did just fine because he makes what he makes. So, all right, steps 4 and 5. Now, as a business owner, you have absolutely got to be in control of steps 1, 2, and 3. You have to manage those. Don't delegate anybody to have control over your money. It's very dangerous. However, steps 4 and 5, you can delegate. Trust but verify. You can hand over executing the plan, paying of the bills, transferring the money to your accountant or someone that you trust, if you have an office manager. And you follow up and make sure that it was done according to the plan. And that should be recorded in your accounting system. And meanwhile, you are back at step 1, having your income planning meeting. So step 1, the sales and income planning meeting. You have to realize at the end of the week is the beginning of the next week. So you're doing a lot of things simultaneously. You're figuring out how much came in, and you're planning out how to spend it. You're getting that plan executed, and you're going right into your next revenue generation meeting. And the only thing I can say is I've been using my own system for 35 years, every week. And the power is not in the decisions that you make, the little decisions every week. That's not where the power lies. The power lies in repeating week after week after week, the same cycle, spending your money to your own best interest, filling those buckets of cash, paying down the bucket of debt. And it's a happy day when that bucket of debt comes down if you're really in debt, and the buckets of cash come up to the point where they are fuller than the bucket of debt. And that's when people start sleeping really good at night and they forget their worries about money. Here's another proven truth. Managed money works harder, it goes further, and it accomplishes a heck of a lot more than money that's spent without a plan. And there are too many business owners who just willy-nilly will grab the checkbook and start writing checks out to pay bills to suppliers to make them wealthy with no thought or planning on what your business needs in the future. So cash flow management and planning plans for today, next week, next month, next year, all the way down to the misty end of the road called your retirement. And you need to plan for your exit plan. How are you going to exit your business? And honestly, that's where I'm at right now. I'm 74 years old. I've been working for a long time. And an exit plan can be, a lot of different things to a lot of different people. Some people, they have a family member who will take over. Some people plan to sell. Some people plan to just shut it down and walk away because they're like a doctor and, it's their clinic and nobody's going to, walk in and buy it and take over. So if you think about it, you have to be in control of your financial future because you can't trust putting that in the hands of someone else and making sure that it's in your best interest and the best interest of your company. You have to act as a fiduciary, which means that you have to, every action that you take has to be in the best interest of the company first and yourself second. And when you do your budget, the budget includes payroll. Like I talked about. And if you have staff, you put your staff payroll on a separate line and you put your payroll on a separate line in the budget. And your payroll, you need to figure out with a cash flow management planning sense that you have, how much it's costing you to run your household, what your family expansion plans are, what kind of things you want to do in the future for family growth, go on trips to learn things or learn about a new country or a new whatever. That all has to be figured into your income planning target for your household. And then that payroll line on your business budget has to be a number that before taxes is enough that once the taxes come out, you are bringing home enough every week or every month to pay those household bills and fund that expansion and the growth. And don't think that you won't have domestic help. If you have babies, you might hire a nanny or you pay for daycare. That could be considered, a payroll that you have to pay out to somebody else for helping your family. Don't think that you don't do promotion as a family because every time little Johnny goes down the street to little Susie's birthday party with a gift in hand, that is promoting to your community that you're doing well and you have enough to, buy little Susie a gift and send Johnny to the party. Or every time you go to a family reunion or go to on an anniversary cruise, whatever it is, your community looks at your family and judges your well-being by what you do and what you can't do. And so you want to give off the signals that you're doing just fine. And so cash flow management and planning helps with that because you can pay off debt and you can afford things because you're setting aside money in buckets of cash for those things.